A lawyer in Chicago makes $340,000 a year. He drives a leased BMW, lives in a house with a mortgage he refinanced twice, and has about $80,000 in his 401k. A plumber in Ohio makes $95,000 a year, drives a paid-off truck, owns his 3-bedroom house outright, and has $420,000 invested in index funds. One of them is in the top 5% by income. The other is in the top 10% by net worth. They are not the same person. They're not even close. And this is the problem with how we talk about wealth in America. We keep confusing the scoreboard with the game. Here's what nobody tells you. The gap between income and wealth isn't a bug in the system. It's the whole point. Today, I'm going to walk you through what it actually takes to hit the top 25%, 10%, 5%, and 1% in America, both by income and by net worth, using 2025 data. And I'll explain why the distance between those two measures is where all the interesting stuff happens. The system is doing exactly what it was designed to do. You just weren't given the manual. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data link in the description. Let me tell you about a concept I call the pile. Imagine every American household has a pile of money in front of them. Some piles are stacks of cash. Some piles are mostly made of paper that says you own part of this house or you own part of this company. Some piles are actually negative. They're holes in the ground filled with IOUs. Now, here's the thing about piles. There's how much stuff lands on top of your pile every year, which is income, and there's how big your pile actually is after years of stuff landing on it or being taken away, which is net worth. These two numbers have a relationship. But it's like the relationship between how fast a car goes and how much gas is in the tank. Related? Sure. But you can drive fast with an empty tank, and you can have a full tank in a car that doesn't run. The top 25% in America by income starts at about $95,000 per year. That's it. If you and your spouse each make $50,000, you're there. A nurse and a teacher, a mid-level manager and an accountant. This isn't private jets and country clubs. This is, we can afford to fix the water heater when it breaks without putting it on a credit card. But here's where it gets weird. The top 25% by net worth starts at about $340,000. That's the threshold. And if you think about it for a second, you realize something uncomfortable. A household making $95,000 a year, paying taxes, paying for housing, food, cars, kids, how exactly do they accumulate $340,000? Let me tell you about someone I'll call Marcus. Marcus is real, but that's not his name. Marcus is an engineer in Denver making $110,000 a year. His wife makes $60,000. They're solidly in the top 25% by income. Nice. But Marcus has been working for 15 years, and his net worth is about $90,000. He's 42 years old. He feels like he should be further ahead. And he's right, he should be. So where did all that money go? Well, he bought a house with a $300,000 mortgage. He's got 2 car payments. He upgraded his kitchen. He went to Hawaii twice. None of this is extravagant. None of this is champagne and caviar stuff. But Marcus made a classic error. He optimized for income and forgot about the pile. This is the first escalation. The gap between being in the top 25% by income versus by net worth is where most middle-class Americans get stuck. They earn enough to feel like they should be building wealth, but they spend enough to make sure they don't. The system doesn't punish them for this. The system doesn't even notice. The system is indifferent. Marcus isn't a victim. He's just someone who never thought about his pile. He thought about his income, which is a number on a pay stub. He didn't think about his net worth, which is a number you have to sit down and calculate on purpose. Now you might be thinking, okay, but isn't home equity part of net worth? Yes, good point. Marcus has about $60,000 in home equity. That's part of his $90,000. But here's the catch, and this is important. Home equity is what I call trapped wealth. You can't spend it without selling your house or borrowing against it. And most people don't want to sell their house, and borrowing against it just creates more debt. so it counts, technically. But it doesn't act the same way as $400,000 in a brokerage account. One of them can be converted into groceries in about 3 business days. The other one, you have to live inside. Let's climb higher. The top 10% by income starts at about $173,000 per household. This is 2 professionals, a doctor and a teacher, a lawyer and a marketing director. You know these people. They live in the nice part of town. They drive cars that are less than 5 years old. They take real vacations, not just long weekends. And by net worth, the top 10% threshold is about $970,000, almost $1 million. Now, here's a question. If you're making $173,000 a year, how long does it take to accumulate $970,000 in net worth? Let's do some math. After taxes, you're taking home maybe $120,000. After housing, food, transportation, and normal life expenses, you might save $20,000 a year if you're reasonably disciplined. At that rate, it takes 48 years to hit $970,000. But the top 10% isn't made up of 70-year-olds. It's made up of people in their 40s and 50s. So how do they get there? This is the second escalation. The answer is they didn't save their way there. They owned their way there. The top 10% by net worth isn't a group of super savers. It's a group of asset accumulators. They own stocks that went up. They own houses that appreciated. They own businesses that became valuable. Some of them inherited money. But the vast majority of people in the top 10% by net worth have one thing in common. They own things that grew without them having to do anything. Their money worked. They didn't just work for money. There's a guy I know. I'll call him David. David is a corporate middle manager. He's made between $120,000 and $180,000 a year for the last 20 years. Nothing spectacular. But David did 2 things that his colleague Marcus didn't do. First, he bought his house in 2004, before the run-up in prices. Second, he put 10% of every paycheck into an S&P 500 index fund automatically for 20 years. He never touched it. He never tried to time the market. He never even looked at it except once a year. Today, David's net worth is about $1.4 million. His house is worth $500,000 more than he paid for it. His investment account is worth $600,000. He's got another $300,000 in retirement accounts. David is in the top 10% by net worth, even though he was never in the top 10% by income until the very end of his career. What's the difference between Marcus and David? Marcus makes more money than David did at the same age, but David built a pile. Marcus built a lifestyle. The system doesn't care which one you choose. It just compounds whatever you give it. Give it savings, and it compounds wealth. Give it consumption, and it compounds expectations. Either way, the math works. But now you might think, okay, but David got lucky with the house and the stock market. That's true, he did. But here's the thing about luck. You have to put yourself in its path. David didn't know the stock market would triple. He didn't know his house would appreciate. He just knew that owning things was better than owning nothing. So he owned things. And when luck came along, he was there to catch it. Marcus spent the same 20 years catching nothing because he never put his net in the water. Let me tell you about the psychology of this. There's a reason most people at the top 25% income level don't reach the top 10% net worth level. It's not because they can't. It's because they don't. The human brain is designed for a world where resources are scarce and status is important. In that world, spending money on visible signals, a nice car, nice clothes, a nice house, makes sense. It signals that you have resources. It signals that you're a good ally or a dangerous competitor. It signals that you're worth paying attention to. But in the modern world, those signals are mostly noise. Nobody cares about your car except the bank that financed it. Nobody cares about your watch except the other people who bought the same watch to signal that they're part of the same tribe. The signaling economy is a trap. It takes money that could be building your pile and sets it on fire for the sake of feelings that last about 2 weeks. This is where it gets really interesting. The top 5% by income starts at about $340,000 per household. These are 2 high earners or 1 very high earner. Specialists, executives, successful small business owners. The top 5% by net worth starts at about $1.1 million. Now notice something. The income threshold for the top 5% is about double the threshold for the top 10%. But the net worth threshold for the top 5% is only about 13% higher than the threshold for the top 10%. What does that mean? It means that high income doesn't translate into proportionally high net worth. The jump from $173,000 to $340,000 in income, that's massive. But the jump from $970,000 to $1.1 million in net worth, that's modest. Why? Because people who make more money also spend more money. This is called lifestyle creep, and it's the enemy of wealth building. I want to tell you about a phenomenon I call the $17,000 mistake. Here's how it works. You get a raise. Let's say it's $17,000 a year after taxes. That's about a $20,000 gross raise. Feels like a lot. You think, finally, I can get ahead. So what do? You upgrade something, a nicer car, a bigger apartment, more frequent vacations, better clothes, private school for the kids. The $17,000 disappears into your life like water into sand. But here's the real cost. If you had invested that $17,000 a year for 20 years at 7% annual return, it would have become about $700,000. Not 17,000 times 20, which would be $340,000. That's simple addition. I'm talking about $700,000 because of compound interest. The $17,000 you spent on upgrades didn't just cost you $17,000. It cost you $700,000 in future wealth. That's the opportunity cost. That's what lifestyle creep actually costs you. Now you're asking yourself, but if I can't enjoy my raises, what's the point of working hard? And that's a fair question. Here's the answer. You can enjoy your raises, but enjoy them after you've secured your pile. Take 10% of every raise and spend it on whatever you want. Take 90% and invest it. You still get the dopamine hit of the upgrade, but you also get the compound growth on the savings. Most people do the opposite. They spend 90% and save 10% if they save anything at all. That's backward. And the system is perfectly happy to let you run that program forever. The system doesn't punish you. It just doesn't help you. You're on your own. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Let's keep climbing. The top 1% by income starts at about $800,000 per household. These are the real earners. Surgeons, corporate executives, partners at law firms, people who run successful businesses. The top 1% by net worth starts at about $11 million. That's not a typo. 11 million. Now let that sink in for a moment. The income threshold for the top 1% is about 2.4 times the threshold for the top 5%. But the net worth threshold for the top 1% is about 10 times the threshold for the top 5%. 10 times. What happened? How did that gap get so wide? This is the third escalation. The top 1% by income includes a lot of high earners who spend most of what they make. The top 1% by net worth includes almost nobody who got there by saving from a salary. Almost everyone in the top 1% by net worth owns something that became extremely valuable. A business, a portfolio of real estate, a large block of stock, often from a company they founded or joined early. They didn't accumulate their way to $11 million. They multiplied their way there. They took concentrated bets on things they understood, and those bets paid off. Let me tell you a parable. There were two brothers. Both were smart. Both went to good colleges. One became a doctor. The other joined a small technology company as employee number 12. The doctor makes $400,000 a year. He works 60 hours a week. He's been practicing for 20 years. His net worth is about $2 million, mostly his house and his retirement accounts. The other brother, the tech company went public. His stock options are now worth $18 million. He works 30 hours a week as an advisor. He's been semi-retired for 10 years. Who made the better decision? Well, the doctor helped thousands of patients. He did meaningful work. But from a purely financial perspective, he lost. Not because he wasn't smart, not because he didn't work hard. He lost because he was playing a different game. He was playing the income game. His brother was playing the equity game. Now you might be thinking, but I can't just join a startup that goes public. That's luck. Yes, it is. But here's the thing. The top 1% by net worth is almost entirely made of people who got lucky in some way. They started businesses that happened to work. They invested in assets that happened to appreciate. They inherited money that happened to be substantial. The difference between them and everyone else isn't that they were geniuses. It's that they put themselves in positions where luck could find them. They owned things. The doctor owned his labor, which he sold for a high price. That's good. But his brother owned equity, which he sold for an astronomical price. That's better. Not because he was smarter, because he was playing a game with a higher ceiling. Now, I want to pause here and address something. You might feel like this is unfair. And you know what? It is unfair. The system rewards ownership more than it rewards labor. That's not a conspiracy. That's just how capitalism works. Capital accumulates. Labor gets spent. If you're only selling your labor, you're playing a game where the best possible outcome is a good income. But the ceiling is capped. You can only work so many hours. You can only charge so much per hour. The people who reach the top 1% by net worth have uncapped upside. They own things that can become worth 10 times, 100 times, 1,000 times what they paid. You can't work 1,000 times harder. But your investments can grow 1,000 times without you doing anything. This is the fourth escalation. There's a level above the top 1%, the top 0.1%. These are the people with net worth above $30 million. About 130,000 households in America. And you know what's interesting about them? Almost none of them got there by earning a salary. They're founders, investors, real estate developers, people who built or bought assets that became enormous. The jump from 11 million to 30 million isn't about saving more. It isn't about earning more. It's about leverage, using other people's money to amplify your bets, buying a $20 million property with $5 million down and letting the tenants pay off the rest, starting a company with investor money and keeping a chunk of the equity. These aren't things you can do with a paycheck. They require a different mindset entirely. Here's a quick comedic cutaway. Imagine explaining this to someone in the 1800s. So you're telling me I can borrow money I don't have, buy a building I can't afford, let other people pay for it, and keep all the profit? Yes, but also there's risk. Risk? I work in a coal mine. I think I can handle risk. The point is, the game has changed. Most people are still playing the old game. Work hard, save money, retire. That game still works, kind of, but it won't get you to the top 1%. That requires a different game entirely. Let me give you a concrete example with real numbers. There's a real estate investor I know named Patricia. She's 62 years old. Her net worth is about $15 million. She's in the top 1%. She didn't inherit money. She didn't win the lottery. She didn't start a company. Here's what she did. In 1994, she bought a small apartment building for $400,000. She put 20% down $80,000. The rent from the tenants covered the mortgage and expenses. 20 years later, the building was worth $1.2 million. She'd paid down the mortgage to about $200,000. Her equity was $1 million. But here's the key. She'd only put in $80,000 of her own money. The rest came from appreciation and mortgage paydown funded by tenants. Then she did a 1031 exchange, sold that building, and bought a bigger one. She did this 5 times over 30 years. Each time, she multiplied her equity. Today, she owns 14 properties worth about $30 million total, with about $15 million in equity. She started with $80,000. She never made more than $100,000 a year in salary. She just understood the game. Now you're asking yourself, but can't you lose money doing this? Absolutely. Patricia had one building that needed a new roof and a new foundation in the same year. She lost $80,000 on that deal, but she had 12 others that were doing fine. The system has risk. The question is, are you positioned to take the risk? Most people aren't. They're one bad month away from disaster. Patricia was positioned to absorb a loss because she had built a pile. She wasn't exposed. She had margin for error. That's what wealth buys you. Not happiness, but the ability to survive mistakes. Here's another quick cutaway. A guy on Twitter, X, once told me that real wealth is mindset. I checked his profile. He rents an apartment and has $47,000 in student loans. Mindset matters, sure, but mindset doesn't compound. Capital compounds. Mindset without capital is just confidence. Confidence is useful, but it's not wealth. Let me talk about the psychological shift that happens as you climb these brackets. At the top 25%, the main anxiety is, what if something goes wrong? At the top 10%, the anxiety shifts to, what if I'm not doing enough? At the top 5%, it becomes, how do I protect what I have? And at the top 1%, the question transforms entirely. How do I make sure my children don't destroy what I built? Each level has its own neuroses. Money doesn't eliminate anxiety. It just changes the flavor. I've met people worth $50 million who are terrified of losing it. I've met people worth $500,000 who feel completely secure. The difference isn't the number. It's their relationship with uncertainty. There's a phenomenon I call the number. Everyone has a number in their head, a net worth figure where they think, if I hit that, I'll feel secure. The problem is the number moves. When you're at 50,000, you think, if I get to 200,000, I'll feel safe. When you get to 200,000, you think, actually, 350,000 is the real safety number. When you get there, you think, no, it's really 500,000. The goalpost slides every time you approach it. This isn't a flaw in your psychology. It's a feature. Humans are wired to want more. It's how we survived as a species. But in the modern world, it's a trap. The key is to notice when enough is enough, to define enough before you reach it. Otherwise, you'll spend your whole life climbing a ladder that never stops. Now you might be thinking, what about taxes? Doesn't the system penalize high earners? Here's the uncomfortable truth. The tax code is written by people who own things for people who own things. High earned income is taxed heavily. High unearned income, capital gains, dividends, carried interest is taxed lightly. If you make $500,000 a year as a salary, you're in the top 5% by income, and you're paying a marginal rate around 37% to the feds, plus state taxes. If you make $500,000 a year in long-term capital gains, you're paying 20% to the feds, and often nothing to the state, depending on where you live. The system rewards ownership and penalizes labor. Again, not a conspiracy, just incentives. I had an accountant explain this to me once. He said, the tax code isn't about fairness. It's about what the government wants to encourage. The government wants to encourage investment. So it taxes investment income lightly. The government wants to encourage business formation. So it offers deductions and credits to business owners. The government doesn't particularly care about high-income professionals. You're not doing anything special. You're just selling your time for a high price. There's no incentive to help you. So they tax you. But if you start a business, if you invest in real estate, if you generate capital gains, now you're doing something the government wants, and the tax code reflects that. You can complain about it, or you can learn to play the game as it's actually written, your choice. Let me give you 3 practical takeaways from all of this. First, track your net worth monthly, not your income, your net worth. Income is what you make, net worth is what you keep. Most people know their income to the dollar and have no idea what their net worth is. That's backward. Net worth is the real score. Write it down every month. Watch it grow or don't grow. That awareness alone will change your behavior. Second, convert income into assets as fast as you can. Every dollar you earn has a choice. Become consumption or become capital. Consumption feels good now. Capital grows forever. You don't have to be perfect. You just have to tilt the ratio. Aim to convert at least 20% of your after-tax income into assets. Over time, those assets will start generating their own income. That's the crossover point. That's when you start winning the game. Third, stop waiting for the perfect opportunity. David didn't wait. Patricia didn't wait. They invested in boring things, index funds, real estate, and let time do the work. They didn't time the market. They didn't find the perfect startup. They just showed up month after month and put money into things that could grow. The perfect is the enemy of the good. The good, done consistently for decades, becomes extraordinary. Lazy investing built more fortune than crypto memes. Here's the thing. The top 1% isn't a club you join. It's a destination you reach, usually without meaning to, by making thousands of small decisions that compound over time. The plumber in Ohio didn't set out to be in the top 10%. He just kept doing the right thing for 30 years. The lawyer in Chicago didn't set out to be stuck in the top 5% of income with middling net worth. He just kept making decisions that felt normal in the moment. The system is indifferent to your intentions. It only cares about your actions, so act accordingly. The gap between income and wealth is where freedom lives. Income gives you options today. Wealth gives you options forever. Most people optimize for today. The people who end up in the top 1% optimize for forever. And they started decades before you ever heard their names.